Inflation has reaccelerated just as an energy shock and bond market turmoil intensify, forcing equities to lean even harder on an AI-driven earnings boom. This is vTalkInsight Equity Pulse Daily for May 13, 2026. Let's unpack how this new macro mix is reshaping equity risk and where the most important signals are emerging. The macro backdrop has taken a more stagflation-like turn after the latest US inflation data. Headline consumer prices are running at about 3.8% year-over-year, up sharply from 3.3% and above expectations, while core inflation is stuck around 2.8%. Under the surface, the monthly numbers show why this is uncomfortable for equities. Headline CPI rose roughly 0.6% month-over-month and core around 0.4%, with services prices still rising about 0.5% while goods are flat. That profile points to sticky domestic inflation rather than a temporary energy blip. Several overlapping supply shocks are feeding that stickiness. Labor constraints, trade disruptions, and an energy shock linked to the prolonged closure of the Strait of Hormuz are all pushing costs higher while gradually eroding growth momentum. Oil is back above $100 a barrel, and around 20% of global supply has effectively been cut off since early March. The transmission into the real economy is increasingly visible. Shipping container base rates are up 10 to 15%. War and fuel surcharges are spreading across routes, and air freight costs have nearly doubled as fuel prices bite. At the same time, copper has surged toward $14,000 per ton, signaling either robust industrial demand or tight supply, or both. For policy, this combination keeps the Federal Reserve firmly in restrictive territory. With both headline and core CPI surprising to the upside, the odds of near-term rate cuts have fallen, and some officials are again floating the possibility of renewed tightening if inflation does not cool. U.S. Treasury yields have responded, with the 10-year moving toward the mid-4% range and the 30-year holding just above 5%. The fixed income stress is even more acute in the UK. 30-year gilt yields have surged towards 6%, their highest level since the late 1990s, as political instability and questions over fiscal discipline drive a pronounced sell-off. The pound has dropped to a two-year low against the euro, and investors are openly talking about UK turmoil as a warning shot for other deficit-heavy economies. Despite this, equity volatility remains only moderately elevated. The VIX is hovering just below 19 and recent S&P daily moves have been relatively contained, even as oil trades above $100 and long-end yields reset higher. That gap between macro risk and equity risk premia is important because it leaves little cushion if inflation or energy surprises turn even more adverse from here. Against that challenging macro backdrop, the equity story is still anchored by remarkably strong earnings. First quarter S&P 500 earnings growth came in around 26% year-on-year, roughly double the consensus expectation of 13%, and analysts now see about 18% growth for the quarter and 24% for the full year. Large-cap technology is doing much of the heavy lifting. Tech earnings accounted for roughly 55% of total S&P 500 earnings growth in the first quarter, with semiconductor names seeing particularly strong momentum helped by supply bottlenecks and robust demand expected to last 6 to 8 quarters. The growth is being powered by a massive AI and digital infrastructure build-out. Consensus expects around $4.45 trillion of capital expenditure by cloud hyperscalers between 2025 and 2030, and companies across chips, data centers, and power infrastructure are positioning for that wave. NVIDIA is reported to have a backlog in the trillion-dollar range, and digital infrastructure capex alone is estimated at about $1.5 trillion. The flip side is mounting concentration and valuation risk. The top 10 S&P 500 stocks now make up about 40% of the index, and the so-called Magnificent Seven account for roughly 18% of a broad global equity benchmark. Semiconductor indices have rallied roughly 25% in the past month and 50% year-to-date, pushing price-to-earnings multiples and positioning to extreme levels. Positioning data reinforce that picture of crowding. Momentum factor exposure is at the 100th percentile relative to the past 5 years, and options markets show aggressive call buying in the biggest tech names, with call volumes back to peaks last seen during the 2021 meme stock surge. Many AI and chip stocks appear to have pulled forward several quarters of potential gains. At the same time, today's cycle leaders are fundamentally different from past bubbles. Mega-cap platforms such as Microsoft, Google, Amazon, and Nvidia are generating substantial cash flows and profits that can fund AI investment internally, which reduces outright bust risk even if valuations compress. Short interest in names like Intel and Qualcomm is elevated, pointing to a sharp divide between bullish AI narratives and hedged or skeptical positioning. Looking ahead, the key question is whether earnings breadth can improve beyond the current AI complex. Asset-heavy sectors such as industrials, materials, and energy are already gaining favor as investors focus on reshoring and infrastructure buildouts, while flows into emerging markets like Korea and Taiwan reflect enthusiasm for their technology and AI exposure. How these areas perform relative to the mega-caps will be a crucial signal for the durability of the equity cycle. Credit markets are echoing the equity story of strong demand for risk tied to AI and infrastructure. U.S. investment-grade corporate issuance has now exceeded net treasury issuance for the first time in a decade, as companies tap markets heavily to finance long-dated projects. That surge is highly global and highly concentrated. U.S. companies now represent more than half of the European corporate bond index, with major tech hyperscalers among the top issuers, and Amazon is coming to the Swiss franc market with a multi-part deal specifically to raise long-term capital for AI infrastructure. For now, markets are absorbing this supply with ease. Credit spreads remain tight, supported by strong corporate fundamentals and high overall credit quality, and higher reinvestment yields around 4.2% are lifting running yields on fixed income portfolios and making credit look attractive relative to government bonds. Beneath those calm headline spreads, private credit is flashing some warning signs. A wave of investor redemptions has forced Blackstone to inject capital into a flagship private credit fund, and recent stress in non-traded business development companies highlights the liquidity risk when retail participation rises in inherently illiquid assets. Regulators are starting to push for more transparency, and any spillover from private to public credit would be a key inflection point for equities. At the company level, several AI-related stories illustrate how policy and governance can shape equity narratives. Nvidia has U.S. approval to export its H200 chip to China, but shipments are reportedly stalled while Chinese regulators review the product, and the absence of Nvidia's chief executive from a recent U.S. delegation to China is being read as a sign that Washington's stance on advanced chip sales remains tight. OpenAI faces a different kind of overhang, centered on governance and legal risk rather than hardware access. Lawsuits, congressional inquiries, and questions about potential conflicts of interest in Sam Altman's startup investments are all creating uncertainty around the company's future structure and any potential IPO, reminding markets that not every AI winner will be decided purely by technology or scale. In contrast, some industrial and infrastructure names are riding the AI wave with cleaner stories. Siemens Energy has raised its outlook and accelerated share buybacks, citing strong demand from data center and AI infrastructure customers, while Zebra Technologies jumped after beating first quarter expectations and lifting full-year guidance, and a small-cap semiconductor stock rallied about 45% on strong results and an optimistic outlook. Consumer and healthcare signals underscore how selective the current market is. On, the sneaker brand upgraded its outlook as it takes share from Adidas, Puma, and Nike, while Under Armour dropped 17% in a day on renewed doubts about its turnaround. Wendy's surged on reports of a potential private equity-led buyout, and RO Diagnostics gained momentum with EU clearance for a blood-based Alzheimer's test and plans to scale U.S. manufacturing for its glucose monitor, all pointing to an environment where stock-specific execution and deal-making matter at least as much as the macro. Stepping back, Equities are being pulled between a clear deterioration in the macro backdrop and an earnings and capex cycle that remains exceptionally powerful, particularly around AI and digital infrastructure. Inflation is running hotter, energy and freight costs are rising, and bond markets from treasuries to UK gilts are repricing to a higher-for-longer world, yet index-level volatility and credit spreads still look benign. On the other side of the ledger, S&P 500 earnings growth is tracking at levels usually seen only after recessions. Hyperscaler and semiconductor demand remains strong, and high-quality mega-cap tech is generating the cash flows to fund its own expansion. The tension is that leadership is narrow, valuations are full, and both equity momentum and AI exposure are crowded, while pockets of private credit and governance risk are beginning to surface. From here, the key signals to watch are the path of oil and services inflation, any shift in central bank rhetoric, the reaction of credit spreads to further volatility, and whether earnings breadth can extend beyond today's AI complex into industrials, energy, and select consumer and healthcare names. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.